Stablecoins are supposed to be, well, kind of boring, right? A digital dollar that just sits there and holds its value. But what if your stablecoins could do more, a lot more? What if they could actually pay you just for holding them? Today, we're diving into the really fast-growing and kind of wild world of yield-bearing stablecoins. It's a place where the promise of high returns comes with some very, very real risks.
So, you've probably seen ads that look a lot like this, right? Promising these insane yields on something as safe as USDC. And no, it's not just some marketing gimmick. See, for years, when you held a stablecoin, the company that issued it was taking your dollars, investing them, and keeping all of the profit. Well, that whole model is getting flipped on its head, and it's creating an entirely new kind of digital asset.
Okay, so this is the absolute key difference. With the old school stablecoins, the issuer, think Tether or Circle, takes your dollar, buys something super safe like US Treasuries, and then just pockets all the interest. You just get to know your coin is worth $1. But with these new yield-bearing stablecoins, that interest gets passed directly back to you. You get the stability plus a paycheck. And we are not talking about small change here. Not even close. Just take Tether, the biggest player in the game. They hold over $150 billion in U.S. government debt, and that generates an estimated $6 billion in interest every year. That massive pile of cash is exactly what this new wave of stablecoins is trying to redirect, away from the companies and back into the pockets of the users. This brings us to a really simple, but honestly a revolutionary new idea, the hold-to-earn model. And it's exactly what it sounds like. Instead of your money just sitting there doing nothing, it's actually working for you 24/7. So what exactly is a yield-bearing stablecoin? Let's break it down. A yield-bearing stablecoin is a token that's backed by stuff that actually generates income. This could be something really safe, like US Treasuries, or it could be more complex, high-risk strategies happening on-chain. But the magic part is that the income from those assets doesn't just go to some company's bottom line. Nope, it flows right back to the people holding the tokens. And you can see why this is so appealing to, well, pretty much everyone. For an everyday user, it's a no-brainer way to make your cash work for you. For DeFi protocols, these stablecoins are way better as collateral because they're an asset that actually grows on its own. And for the big institutions, it's a clean, transparent, on-chain way to tap into traditional yields without all the usual overhead. Now, this space is already full of projects, and they are definitely not all created equal. You have a huge range of risk. On one end, you've got Athena's USD, which generates its super high but also super volatile yield from some pretty complex crypto trading strategies. Then, on the more conservative end, you have projects like Ondo and Frax that are mostly backed by plain old US Treasuries. It really highlights the fundamental trade-off here. If you want a higher yield, you almost always have to take on higher risk. Which, of course, brings us to our next chapter. What happens when these complex, high-yield systems get put under some serious stress? Well, the story of Athena gives us a pretty powerful and pretty cautionary answer. So, back in late 2025, a brutal market crash put Athena's whole model to the ultimate test. And the result was dramatic. Just look at this quote. The total value locked, that's just the total amount of money inside the protocol, was literally cut in half as investors panicked and ran for the exits. So here's how it all went down. First, the crash caused USDE to depeg, meaning for a moment it wasn't worth $1 anymore. That little wobble was enough to shatter confidence. Immediately, users started redeeming their USDE, trying to get their money out as fast as they possibly could. And this wasn't just a quick dip. The panic selling lasted for 2 whole months. By December, half the money in the entire system was gone. The sheer scale of the money leaving was just staggering. In just 2 months, a total of $8 billion was pulled out of the Athena protocol. It was the ultimate stress test, and it revealed a fatal flaw. The yield strategy was great when markets were calm, but it completely shattered under pressure. And the damage didn't stop there. The crisis hammered Athena's own governance token, ENA. You can think of that as the stock price of the project. It plunged 62%. It's just a perfect, brutal example of how a problem in one corner of a crypto project can spread like a virus and wipe out value everywhere else. The Athena event isn't just a story about one protocol blowing up. It points to a much, much bigger question about the future of money itself. As these powerful, private, digital currencies get bigger, how are they going to play with each other? And with the public financial system that we all depend on?
And this is where institutions like the Bank for International Settlements, or BIS, come into the picture. The BIS is basically the central bank for all the other central banks, and you better believe they are studying this new competitive landscape very, very closely. And their research gives us a great way to think about what might happen next.
A really key concept in their analysis is this idea of walled gardens, and it's a great metaphor. Think of these private payment systems, like stablecoins or big tech payment apps, as their own little worlds. Everything works great inside the walls, but trying to send money or interact with anyone outside that system can be difficult or expensive. And this can lead to the whole financial system breaking up into little pieces. So this sets up two competing visions for our financial future. On one side, you have a world of private, competing walled gardens that don't talk to each other. On the other, you have a more unified world built on public infrastructure, things like central bank digital currencies or fast payment systems that are designed from the ground up to make sure everything works together smoothly. The whole goal of public infrastructure is to prevent that fragmentation and include more people in the system. And the conclusion from the BIS model is pretty clear. Having a public option, one that guarantees all these different payment systems can actually connect with each other, creates a better outcome for society as a whole. It can bring more people into the financial system and just improve welfare for everyone, even if it means the big established banks lose a little bit of their market share. So, with this tension in mind, between private innovation and public stability, where does the market actually stand today? And what's coming next? Well, right now, the stablecoin market is the textbook definition of a walled garden ecosystem. It is completely dominated by two massive players, Tether and Circle. Between them, they control over 90% of the market. So the fierce competition we're seeing isn't really creating an open marketplace. It's more like a battle between a few giants for who can build the biggest fortress. And yet, despite all the risks we've talked about, real-world adoption is just accelerating like crazy. About a third of businesses are already using stablecoins today, and that number is expected to pretty much double within 3 years. And the reason why is simple and powerful. They make payments faster and cheaper than the old banking system. For businesses, that kind of efficiency is just too good to pass up. Now, regulators are definitely not sitting on the sidelines anymore. New rulebooks are being written all over the world to manage these risks. In the US, you have proposals like the Genius Act, and in Europe, you have the MiCA regulations. Both are designed to set clear rules for how stablecoins have to be backed and how transparent the issuers need to be. This is a crucial step to making the whole ecosystem safer for everybody. Which leaves us with the ultimate question. On one hand, we have this incredible innovation that promises a more efficient, user-focused financial system. But on the other hand, we have very clear evidence of the massive risks involved. The path forward is going to be defined by this delicate dance between letting innovation run wild and putting in the rules needed to protect the system. Right now, the outcome is anything but certain.